Hello everyone, welcome to my video on net capital flows in a small open economy. Briefly to let you know where we've been so far, we have the small model with exogenous savings and an investment as a function of interest rate. And in a closed economy, equilibrium happens where savings equals investment there. That's in a closed economy. You get that by setting savings equal to investment, solving for R. We're not in a closed economy anymore. We have an open economy, which introduces some world interest rate, and we're calling it a small open economy because we're setting this market's interest rate equal to the world interest rate. Nothing else. We have no effect on it. Whatever it is determines what happens in our market and not vice versa. So before we get into it, let's talk about what net capital outflows are. This is the amount of money that we lend to other countries minus the amount that they lend to us. So if it's greater than 0, that means we lend more than we borrow. And if it's less than 0, then we borrow more than we lend. Okay, so let's look at it in this model. Say the world interest rate is 12.5%. Let's see, savings is still 100, it's fixed. But the the investment as a function of the interest rate, 12.5 is 1,000 over 12.5 is 80. So we've got savings equals 100, investment equals 80. We save more than we invest. That means we've got extra money floating around in this economy. Savings minus investment equals 20. This extra money flowing around is going to become net capital outflows. That's money that we can lend to another country. So anytime you see this up here, where savings is greater than investment, that's positive net capital outflows. Which also is going to be linked in our little identity that's mentioned elsewhere to positive net exports. That's because we're giving them money in terms of our savings, and they will then take that money and buy something from us. Alrighty. Now let's look at a different situation. What if the world interest rate is 5%? Well, savings is still fixed at 100, but our interest rate is going to be 200. How did I get that? I said I of 5 is equal to 1,000 over 5 is 200. Well, now what does this mean? It means that savings is 100, investment is 200, which means our savings minus investment is equal to minus 100. We're investing $100 more than what we're actually saving. That means we have to borrow money from someone else. And that borrowing from someone else is a net capital outflow that is less than 0. Which then also means that our net exports are less than 0. I don't know. I don't really think there's much else to say about this. I just wanted to give you some mechanics in the model to see how it might work. I hope it's helpful to you. If not, too bad. Good luck, guys. Thanks for watching.